In September 1998, the global financial system came within days of a serious crisis, and the people at the center of it were arguably the most intelligent group ever assembled inside a single investment firm. The fund was called Long-Term Capital Management. Two of its partners, Myron Scholes and Robert Merton, had won the Nobel Prize in Economics 1 year earlier for their work on pricing financial risk. Beside them sat a former vice chairman of the United States Federal Reserve and one of the most respected bond traders on Wall Street. These men had quite literally helped write the mathematics of risk. In under 4 months, their fund lost an estimated $4.6 billion. That September, a group of banks and brokerage firms put $3.6 billion into it through a rescue organized by the Federal Reserve Bank of New York. The rescue was not designed to protect the partners. It was designed to stop the fund's collapse from dragging the wider financial system down with it. Nobel laureates in risk had been undone by risk. And that leads to the strange central puzzle of money. Intelligence, education, and technical skill are not what separate people who build wealth from people who never do. If they were, the smartest people in finance would never go broke, and the wealthiest people on earth would all be mathematicians. Decades of research in psychology and behavioral economics point somewhere else entirely. Financial outcomes are driven far more by behavior than most people realize. How you were raised matters. So do what you fear and how long you are willing to wait. Over the next few minutes, we will look at 3 forces that shape almost every financial decision a person makes. Where your beliefs about money come from, why fear repeatedly overrules arithmetic, and why patience is the simplest idea in finance, but one of the hardest to practice. If you find this kind of breakdown useful, consider subscribing to Future Wealth Lab. Let us begin with something most people never question, where their financial instincts came from in the first place. In May 1991, chartered aircraft left India carrying crates of gold. The shipments were kept quiet while they were in the air. India's foreign exchange reserves had fallen to roughly 3 weeks of import cover. Default was no longer unthinkable. That year, close to 67 tons of the country's gold were pledged abroad to raise the hard currency needed to keep the country solvent. An entire generation of Indian savers watched it happen. Then, almost immediately, they watched something very different. Over the following 12 months, the Sensex rose almost 4-fold. Ordinary families entered the stock market, many for the first time, following a broker named Harshad Mehta, who had become a national celebrity. Then, in April 1992, journalist Sucheta Dalal exposed how much of the money was really moving. Fake bank receipts had been used to pull thousands of crores out of the banking system and push that money into share prices. By August, the market had given back more than 40%. Consider what those 2 events taught the people who lived through them. Currency can fail, markets can be manipulated, gold feels real, and a fixed deposit feels safe. For millions of households, those beliefs were not irrational superstitions. They were conclusions drawn from events they had personally witnessed. There is serious research behind this pattern. Economists Ulrike Malmendier and Stefan Nagel examined decades of American household data to understand how personal experience affects financial decisions. They found that people who had lived through weak markets invested less in stocks, accepted less risk, and expected poorer returns in the future. Recent experiences mattered most, but events from early adulthood could still influence decisions decades later. Not education, not income, experience. The financial world you live through becomes the financial world you expect to continue. That means a young investor entering the market today may be running on completely different psychological software. Someone who began investing after 2020 has experienced growing participation, rising systematic investments, and long periods of market optimism. Their instincts feel obvious to them as well. But those instincts were also written by one specific period in economic history. So the first lesson is simple. Almost nobody believes they are being irrational about money. People are usually acting consistently with the evidence they personally collected. The useful question is not only whether your financial rules feel correct, but which period of history wrote them for you. That brings us to a harder problem. Even when people know the correct financial answer, they often do the opposite. In 1979, two psychologists published a paper that would eventually reshape economics. Daniel Kahneman and Amos Tversky were studying how humans actually make decisions under uncertainty, rather than how traditional economic models assumed they behave. What they found was an imbalance between gains and losses. Losing money usually hurts considerably more than gaining the same amount feels good. Later estimates often describe the emotional impact as roughly 2-to-1, although the exact ratio varies by situation and study. Losing 10,000 rupees can feel far more significant than gaining 10,000 rupees. That asymmetry explains an enormous amount of financial behavior. It helps explain why people sell successful investments too early in order to secure the pleasure of a gain. It also helps explain why they hold losing investments for too long. Selling makes the loss permanent, visible, and emotionally real. The same psychology appears during market declines. Fear becomes so uncomfortable that investors sell precisely when prices are already depressed. Kahneman received the Nobel Prize in Economics in 2002. Tversky had died 6 years earlier, and the prize is not awarded posthumously. The financial cost of this behavior is measurable. In a landmark study of more than 60,000 American households, Brad Barber and Terence O'Dean examined trading records from the first half of the 1990s. The households that traded most earned around 11% a year, while the market returned close to 18%. Excessive trading, transaction costs, and poor timing substantially reduced their returns. More recent research points in the same direction. Morningstar has found that investor returns can fall below the returns produced by the funds themselves because of when people choose to add or withdraw money. Researchers debate the precise size of this behavior gap, but the broader pattern is clear. Frequent emotional decisions can reduce the returns investors actually receive. In India, the evidence from equity futures and options is even more striking. A study by the Securities and Exchange Board of India found that 93% of individual traders lost money across the financial years 2021 to 2022 to 2023 to 2024. Their combined losses exceeded 1.8 lakh crore rupees over those 3 years. Many participants continued trading even after repeatedly losing money. These were not necessarily people who had never heard of risk. Many had access to financial information, trading platforms, charts, and sophisticated products. That is precisely the point. More information can increase confidence, and confidence can increase activity. In investing, more activity does not automatically create a greater advantage. Very often, it creates more opportunities to make expensive, emotional decisions. So the second lesson is that the enemy is rarely ignorance alone. It is the emotional price of remaining still while uncertainty unfolds around you. That leads to the final force. It is the one people understand mathematically, but struggle to feel emotionally. Warren Buffett bought his first stock at the age of 11. By the time he turned 65, he was worth roughly $3 billion. That was already a serious fortune. But it was only a small fraction of what would come later. Today, in his mid-90s, his wealth is estimated at around $150 billion. Greg Abel became chief executive of Berkshire Hathaway on January 1, 2026, while Buffett remained chairman. Look carefully at the scale and timing of Buffett's wealth. The overwhelming majority of it arrived after the age at which most people retire. His skill did not suddenly appear in his 70s. If anything, Berkshire's percentage returns became harder to maintain as the company grew larger. What changed was the base of capital and the amount of time it had been compounding. a very large number was allowed to grow for a very long period without being interrupted. There have been investors who achieved higher annual returns than Buffett over shorter periods. Very few have combined strong returns with his extraordinary duration. This is why compounding is psychologically difficult. It produces very little that feels impressive during its early years. Then, much later, it produces most of the visible result. The human brain tends to imagine progress in straight lines, but compounding does not move in a straight line. For years, the curve appears almost flat. It can feel as though nothing meaningful is happening. Then the accumulated gains begin producing gains of their own. By the time the curve becomes dramatic, many people have already abandoned the process. Modern finance makes patience even harder. Quarterly earnings, daily price alerts, and trading applications constantly direct attention toward what changed today. Every time you unlock your phone, you can see whether your portfolio moved up or down. But the mechanism that creates long-term wealth is almost invisible on that timescale. So the third lesson is uncomfortable. The objective is not necessarily to earn the highest possible return in every year. The objective is to earn a reasonable return that you can continue holding through uncertainty. A modest result compounded for 40 years can outperform a spectacular result that ends after 7. That takes us back to the Nobel laureates at long-term capital management. Their models were not foolish, and much of the mathematics behind them remains influential. What destroyed the fund was the behavior built around those models. The partners borrowed heavily and assumed that relationships that had held in the past would continue during extreme stress. When Russia defaulted in 1998, markets that had historically moved independently began moving together. The fund's leverage magnified every error until there was almost no room left to recover. The failure was not simply in the equations. It was in the confidence, borrowing, and decisions surrounding those equations. That is the thread connecting all three stories. We inherit financial beliefs from the particular period into which we were born. Fear can convert a temporary decline into a permanent loss. Impatience can interrupt the one process that reliably becomes more powerful with time. None of these is primarily an intelligence problem. They are behavior problems. And behavior can be observed, questioned, and changed. Raw intelligence alone offers no such guarantee. Wealth is not automatically built by the smartest person in the room. It is more often built by people whose behavior supports decisions that may take decades to pay off. That means understanding money is not only about learning how markets work, it is also about learning how your own mind behaves when money is involved. In the next episode, we will examine a related question that is becoming increasingly urgent. As artificial intelligence reshapes which skills the economy rewards, what will determine who becomes wealthier and who gets left behind? For more documentaries about money, power, and the future economy, subscribe to Future Wealth Lab, because the most important financial system you will ever need to understand may be the one operating inside your own mind.